Hey investor friends, I'm Michelle Markey and I'd like to welcome you to the greatest meme of all bubbles on earth, with all-time highs in the stock market, cryptocurrencies, commodities, and random other things. And just like the Tulip Mania, South Sea, Nifty 50, and .com bubbles before them, I think we're playing a giant Jenga game with things like GameStop, AMC, BlackBerry, Hertz, Kodak, Nikola, and also Bitcoin, Dogecoin, IPOs and SPACs, and things like silver and gold, and US national debt, and of course the FANG stocks, and not to forget Pokemon cards. And I bet first editions of this Charizard card will go for a lot, but having lots of Jigglypuff cards probably won't go so far. But just like the Nintendo 64 game where Jigglypuffs are being blasted out of the game in the melee between players, I think that we might be coming upon some sheep falling off a cliff. And with the sheep falling off a cliff, I mean that an impending implosion of all of these bubbles could be imminent, but I'm not holding my breath. And although I'm not supposed to prognosticate, I kind of think that we might be headed for a bursting of the bubble, maybe towards end of 2022 or 2023. But nobody knows when this game of musical chairs will stop. So I guess we'll see what happens. With all this money printing going on, it's inflating asset prices, including stock markets, housing, and so many other things. What do you think? Do you think we're in a bubble? Either way, I hope you'll enjoy this sugar high while we're on it. And I hope you'll please like and subscribe to my video and YouTube channel. I'd greatly appreciate it. Thanks. As much as we might think the NASDAQ and tech stocks are overvalued and have pockets of bubbles all over the place, it doesn't compare to what some articles are calling the mother of all bubbles, or also known as Bitcoin. And Bitcoin recently hit a price of over $57,000, and this is triple what it was at its height in 2017. And this type of belief that people have in Bitcoin shows that as long as people are willing to pay for or buy something, it keeps on increasing in value, that otherwise it may not have as much intrinsic value. I mean, the thing that Bitcoin seems to have going for it is that it seems to, for now, serve as a store of value, just like fiat currency. But unlike fiat currency, this can serve as a better medium of exchange, and it's also backed by a nation state, or also the government or its military. And obviously this is not a real $1 million, although it looks pretty convincing, and it's actually pretty cool looking with the Mount Rushmore also in the back of this fiat currency. But with cryptos, I'm not the most experienced in it, but I just wonder if with the bubble that's happening in cryptocurrencies, where will all this money go that people have converted from fiat currency into things like Bitcoin and the other cryptos? If one day people make a run with their money, and similar to how there was a bank run in the Great Depression, will people run on Bitcoin and want to redeem their money back into US dollars or other currencies that are recognized by other world governments? Who knows? But I'm kind of not trusting what's happening in the crypto world, so I'm staying out of it. I've come across a few articles that support my thesis that we're in a huge stock market bubble, even though I don't know if the good times will end anytime soon. But one of these articles comes from investor Jeremy Grantham, and in his article from early January 2021, he writes, "Waiting for the Last Dance." And in this article, he talks about how we are at the late stage end of a long bull market since 2009, and we're met with hysterically speculative behavior, and it's the type of irrational exuberance that's being displayed in the stock market and other markets right now. And in this article, he talks about how we can't have our cake and eat it too. In other words, we can't keep paying high prices for assets that will, at these prices, yield low returns in the future, and that also in the past, previous bubbles were happening in almost perfect monetary and economic conditions that people thought would just last forever. And this time we're faced with a COVID pandemic where a lot of the economy isn't in great shape throughout the world, and yet the stock market is reaching all-time new highs recently, which doesn't seem very sustainable. And in Jeremy's opinion, he thinks that we're somewhere between the equivalent of July 1999 through February 2000, which was the peak right before the stock market crashed in March 2000 in the dot-com bubble. So in a similar vein, he thinks that the ultimate statement for moral hazard is that a lot of people think that high prices of the stocks are justified by low interest rates being kept low on this path indefinitely, and that's also not sustainable. And then other things that Jeremy says includes that it always pays if you're a professional investor to be bullish because it's intellectually undemanding and people like optimism. They don't like a realistic appraisal of what's really happening. And so Jeremy says now that he's no longer a professional money manager, he doesn't have the kind of career risk that other people might have. So he can kind of say whatever he feels like. And another thing he suggests is if we're feeling brave enough that we can consider investing in value and emerging stocks. And that's what some of his best advice is. And otherwise, this is going to be one of the greatest bubbles of his lifetime. And he's kind of excited to see what shakes out. And then also to add to that, he's added indicators that a lot of value investors use and which a lot of people have been dismissing lately and saying that maybe some of these things have lost some of their helpfulness, but I still think they carry value. And they include things like the Warren Buffett indicator, or also known as the Wilshire 5000 total market cap over GDP, which is currently at 217% of GDP. So that means that the total market cap stands to be at around $46.6 trillion as of recent figures from January 2021. And then to add to that, the Robert Shiller CAPE ratio, or cyclically adjusted PE ratio, stands to be somewhere around the mid-30s. And that's at the highest percentage of where it's ever been when we compare it to the dot-com bubble. So with all of these very helpful points, it's reassuring to me that at any point the bubble could burst, but I have a feeling that people want to keep the party going and we're not going to see the crash as soon as we'd like. I mean, if we're lucky, maybe in 2021, but I'm not necessarily expecting it. Echoing Jeremy's sentiment and suggesting that even Wall Street could be worried about a stock market bubble is this PBS article that talks about how GameStop's stock price soared over 1,625% in January, and that corporate profits are being outpaced by stock prices, so that doesn't bode well for future returns. And then also that we've had the highest amount of IPOs since the dot-com bubble, including special purpose acquisition companies, or known as SPACs, have also been booming lately. And not to beat a dead horse, or bull in this case, but even legendary investor Ray Dalio says that we're in the problem part of the current cycle, in which he's expecting us to have low returns in the future, as low interest rates have been inflating assets into bubbles. So I'd like to listen to Ray because I think he's got a pretty great macroeconomic view of what's going on, and he's someone to kind of heed what's happening. Another article that reassures me that yes, we're in a stock market bubble is this one by Lance Roberts on Seeking Alpha from February 2021. And he talks about how the Federal Reserve's mandate is to maintain price stability and full employment. And he asserts that the two pins that will burst the bubble include inflation going up and then finally the Fed raising interest rates, such that a lot of this crescendos by 2023 and things are bursting. And I read through some of the comments of this article, and some people agree, and there's a lot of people who vehemently disagree. And I kind of enjoy seeing the two sides of how people feel and how much sentiment there is that's leaning towards excessive optimism. Because like this article also says, a lot of this is escalating until it stops all at once. You might be feeling like Alice in Wonderland and having fallen down a rabbit hole and landed in a world of bubbles and wondering how we got here. And it starts out with a liquidity story when we go back to the great financial crisis, in which central banks all over the world had a quantitative easing explosion, or what people commonly call money printing. And this money printing was done to provide liquidity to commercial entities like banks and other organizations so that they wouldn't go under and that the economy wouldn't keep suffering the way that it had been. So by having enough liquidity, it could keep certain businesses afloat, and that could also help spur lending when interest rates were cut low, and so that there could be more economic activity that was getting going again in the aftermath of the great financial crisis. So we go from having somewhere like $2 to $3 trillion worth of assets that central banks have added to their balance sheets. And this is all over, whether it's Bank of Japan, the US Federal Reserve, the European Central Bank, or ECB. And then this more than triples by now in 2021, where we're seeing the US Federal Reserve at $7.5 trillion, which is double what it was when it was trying to wind it down. And it got down to as low as $3.75 trillion back in August of 2019. And then now we've thrown some of that out the window. And in doing this, it's no wonder that we've gotten to the point of assets being massively inflated by so much money in circulation. It's kind of figurative. It means that the recipients of some of this printed money needed to put it somewhere to generate some yield, and that basically means that a lot of it ended up in the stock market. All this money printing is such a big deal that it's a central premise of the second most watched Netflix show of all time, La Casa de Papel, or also known as Money Heist. And in a pivotal scene in season 2, the professor says to Inspectora Raquel that the European Central Bank printed $500 billion between 2011 to 2013 in what they called a liquidity injection. And the professor claims that he's doing the same thing, but instead of the liquidity injection going to the banks, he's trying to do it in the real economy in this fictional story. And I find it super compelling and super amazing that they made that one of the reasons why the professor pulled off one of the biggest bank heists in wanting to print his own money, because in a lot of ways, that's kind of what a lot of people are doing with cryptocurrencies, is that it just seems like you get a bunch of GPUs to mine some of that crypto and you create value out of nothing, which is similar to what Money Heist did in all that money printing they did in the show. Remember the good old days when unemployment was low and surprisingly GDP was also kind of low at 2% back in 2019. And then we got our butts handed to us with a negative 3.5% real GDP in 2020. And then we otherwise have a mixed bag of what's to come. And the Congressional Budget Office is projecting that we'll have a 3.7% GDP, so that's good because that's in positive territory. But otherwise, the real US economy doesn't paint such a perfect picture, in that we have a mixed bag of top US economic indicators, as what I'll show here, in that things like, it's good for now that we have an inflation rate of 1.3% with personal consumer expenditures, or PCE index, that the Fed uses when they gauge their inflation targets, and they try to keep it at 2%. But we're still at an unemployment rate of 6.3%, and we're missing about 9.1 million jobs, and that's pretty consistent with a moderate recession according to the New York Times. And there's a whole mixed bag of the rest of these indicators, as you see on the slide, and I won't belabor them, but it's just something to keep in mind, in that we're not fully out of the woods. And even on this cool chart by the Visual Capitalist, all of the graphs on here seem to be kind of in negative territory compared with inflation being relatively low right now. And if that's the best thing we've got going for us, I'm a little bit worried because these other indicators don't look so hot. Just to play devil's advocate for a second, I kind of wondered if there is a price to earnings ratio for the S&P 500 that can justify what seems like never-ending high stock market prices. And I go to this Wall Street Journal article from July 2019 that asks the question, can low rates justify high stock prices? And they say not so fast. And I take this example and I learned that there was this popular 1990s model called the Fed model where the US stock market is a decent place to invest as long as the yield is somewhere above what you can get for the 10-year US Treasury. So let's take an example from mid-February. So the 10-year US Treasury was 1.34%, and the effective federal funds rate was 0.09%. So that's pretty low for an interest rate. And then the forward estimate for the S&P earnings yield is 3.08% for March 2021. So if you do the quick math of 3.08 minus 1.34, you get a yield of 1.74%. That's more than what you'd get in a 10-year Treasury bond. So in that sense, you might think we can be justified in having higher stock prices, but it just seems that that's not also what the Wall Street Journal article thinks. It says that you're standing on flimsy ground if you believe today's low interest rates means stocks aren't overvalued. In my previous example, I sourced the S&P 500 PE ratio from wide charts, and in this example, I find it curious how the S&P 500 is projected to have a PE ratio go down from 40 in Q4 2020 all the way down to 25 by the end of 2021. So I wonder if this is a harbinger of things to come. In another interesting little pattern, I'm trying to channel my inner Sherlock Holmes with inductive reasoning on this observation. And this involves the midpoint of generations. So if you look at the middle point of each generation in the recent history of baby boomers, Gen X, and millennials, we see something that I think is fascinating or just a coincidence. So in 1990, the midpoint of the baby boomers were 35, or those born in 1955 or around there. And that's when there was a recession in 1990. And if you also look at Gen X, they were 36 during the Great Financial Crisis, or the midpoint was around 1972 when they were 36 in 2008 during the GFC. And then now the midpoint of millennials, when those born in 1989 will be turning 34, that will be right in 2023. So I feel like we're getting close, and in other coincidences, some of the baby boomers and Gen X's were getting close to their early 50s during some of the last financial crises. Like the GFC affected baby boomers in their prime earning years of early 50s, and the legit recession we're about to have, or that we're currently in, if it's about to get worse, this is going to affect now Gen Xers who are in their early 50s, in the middle point range of that generation. So maybe this is just all coincidence, or something interesting that will lead to a weird correlation with our generations. If we go down memory lane, in a not so distant past, a year ago, when the coronavirus pandemic was first hitting the rest of the world and stock markets were starting to freak out, that's when the S&P 500 dropped by 34% very quickly. And just as quickly, when the feds and the US government came to the rescue with their liquidity injection, the stock market was like, hey, the coast is clear, let's keep rallying. So I feel like the bull market never really ended. And I kind of wonder if this is going to be a massive dead cat bounce at some point, because I'm kind of afraid of this idea that the roaring 2020s are just going to keep partying on like it's still 1999 and continue up on towards a mark of 5,000 in the S&P 500, while right now we're still pushing 4,000. And so I kind of worry that we're not done yet living in this bubble. And I know that as soon as the herd is mostly vaccinated, maybe people will stop playing around in the stock market as much and start living life again and go outside. And maybe that could happen by as early as the summer 2021. But I don't feel so optimistic that we'll have a reset of our stock market to reflect the real economy. It kind of just feels like we're enjoying living in this make-believe world of, everything is great in the stock markets and everything is awesome like the Legoland movie goes. I recently learned about this very fascinating character from his GameStop comments and actions named Chamath Palihapitiya. And back in March 2019, he shared some very interesting comments in this podcast that I wonder if they're sort of foretelling what's to come in the near future. And back then he said somewhere in the next 3 to 5 years, trouble is going to come from the debt markets. And if we thought the great financial crisis was a big deal with the mortgages, he said, wait till companies start defaulting on all their debt. And it's going to come to a point where a lot of institutions are going to want to have liquidity or solvency for that matter. So it's going to be fascinating to see what shakes out there if he proves to be right. And then from this other article by Harry Dent, he talks about how we're going to have weak fundamentals and a down market and down economy that stays with us longer than the virus will into 2022 and 2023, where things will just keep getting weaker. So a lot of what I've been seeing seems to support this notion that this could be the big one, like really the big one coming in the next couple of years. And it could be the opportunity to create generational wealth of a lifetime. Just like Charlie Munger says, nobody knows when bubbles blow up. I'm also trying to just think about what action steps I can take while I've been prognosticating. And I have this handy dandy to-do list as I'm waiting for the bubble to eventually burst. And this includes 3 strategies, and they're focused on having a cash strategy, an investment strategy, and a general life strategy. So this is just, in my humble opinion, what I'll do. And I'm not saying that you should do it, but this is what I'm comfortable doing for now in my investing practice. So here you'll see that since 2018, I've been sitting on a bucket of cash and it's just sitting around a la Warren Buffett, have a bucket, not a thimble ready when it rains gold. And I'm trying to stave off some inflation by taking advantage of new credit card and bank account bonuses, like spending $500 to get $200 or parking $10,000 to get $350 in interest over 3 months. And in general, I'm just trying to maintain patience, fortitude, and conviction to bravely stand or cower in the face of unrelenting low interest rates and inflation that's eating my cash alive like Pac-Man having a picnic. And then when it comes to my investing strategy, I'm not completely hiding my money under a bed. I have a small percent of money in investments so that I'm not totally FOMO, and in case I'm wrong about this whole impending doom, stock market crash and recession. And then I keep studying generally and non-committally. So I keep learning how to swim for when the tide eventually goes out, just like how Warren Buffett and Charlie Munger keep swimming. And then I have a wish list ready of stocks that I'd buy at certain prices based on intrinsic business valuations I've calculated. And maybe I'll take a leap of faith by looking for undervalued stocks to buy, and maybe I'll study them some more and commit a little bit of funds towards them. But a strong downward riptide could take this out in no time. So am I willing to hold this through the depths of despair? And I also don't want to let perfection of market timing be the enemy of trenching in somewhat, even if the buy price isn't precisely a certain percentage off. And then I would like to try to figure out practical ways to value invest in emerging markets, but I kind of feel meh about it. And this is sort of beyond the edge of my competence too. And I want to brace myself like Odysseus strapped to the ship mast and ignore the voices that sing to buy at the highs in case the bubble bursts by 2023 and maybe it doesn't bottom out till 2025. What if we have a new Great Depression coming along? And then in general, for my life strategy, I'm just gonna keep living and spending on meaningful experiences while saving and embracing a minimalist lifestyle, kind of like Marie Kondo. With the advent of things like tiny houses, not that I live in one, but I know a lot of people from my generation are trying to minimize expenses as much as they can. So that's what I'm gonna do to try to survive whatever's happening now. And as much as it pains me to not be compounding my hard-earned money in the markets right now, I'm trying to save myself for something better. And hopefully, if I follow Warren Buffett and Charlie Munger, I hope that I'll be able to reap rewards sometime in the future. To leave you with the last lesson for today's video, I go back to Warren Buffett's Berkshire Hathaway annual meeting in May 2020, when Warren Buffett reflected on the original roaring 1920s and what happened during the Great Depression and its aftermath. And he cites the Dow Jones Industrial Average being at its peak on September 3, 1929, and then its subsequent crash to decline 48% to its low in November 13 of 1929. And it took 25 years until 1954 for the stock market to reach back to the height that it was in that September 1929. And a lot of people were very traumatized by what they went through in the Great Depression. And Warren Buffett said that people went through a lot of negative things in the past, and we will overcome the worst of the pandemic. And there's a lot of opportunity to invest in America. And then he says, never bet against America. However, we should be careful how we invest, is a lesson that I don't take lightly from Buffett. And he also goes on to say again, never ever bet against America. So what do you think about all these trends and observations? Do you agree that we're in a massive stock market and everything bubble? And what is your investment strategy? I'd love to hear from you in the comments. And if you enjoyed this video or learned something, please like and subscribe. I greatly appreciate you watching. Thanks. Till next time.